580. That number by itself has never taken a dollar from anyone's checking account. But hand it to a car dealer, a landlord, or a mortgage lender, and it starts quietly rerouting tens of thousands of dollars away from you and towards someone else, without a single line item ever explaining why. Here's the thesis this whole video runs on. A credit score was never designed to measure whether you're responsible with money. It's a pricing tool. It exists so a lender can glance at 3 digits and instantly decide how much extra to charge you for borrowing the exact same amount of money someone else borrows for half the price. Same car, same house, same credit card, wildly different price tag, and the only variable is that number. So let's place 580 on the actual map, because most people know it's bad without knowing how bad. FICO scores run from 300 to 850. Above 800 is exceptional, 740 to 799 is very good, 670 to 739 is good, which is roughly where the largest single group of American adults lands. 580 to 669 gets labeled fair, and anything under 580 drops into poor. 580 sits right on that dividing line, one missed payment from falling into poor, one clean year from climbing into fair plus. And that matters more than it sounds, because so much of lending isn't a smooth curve. It's a series of cliffs. Cross a threshold and the pricing changes instantly, not gradually. Now watch what happens when that number walks into a dealership, because this is where the abstract turns into real money fast. Say 2 people each buy the same $35,000 car, same model, same year, same 60-month loan. The buyer with a 750 score gets offered something close to 6.5% interest. Their payment lands around $684 a month, and over the life of the loan they pay about $6,000 in interest on top of the car's price. The buyer with a 580 score isn't getting 6.5%. Subprime auto rates commonly land somewhere between 15 and 20%, and at 18%, that same $35,000 loan runs closer to $900 a month. Stretch that across 60 months, and the total interest paid climbs past $19,000. Same car, same dealership, maybe even the same afternoon. One buyer pays $6,000 to borrow the money. The other pays $19,000. That $13,000 gap isn't a fee anyone can see on paperwork. It's baked silently into the interest rate line, which almost nobody actually reads out loud at the signing table. Follow that same number into a mortgage, and the gap gets even stranger, because a mortgage is the one place a 580 score can technically still get approved. FHA loans allow a minimum score of 580 with just 3.5% down, which sounds almost generous. But the rate attached to that approval tells a different story. A borrower at 750 might lock in somewhere around 6.5% on a $300,000 home, landing at roughly $1,890 a month in principal and interest. A borrower at 580, even qualifying through that same FHA program, often ends up closer to 8% once lender risk pricing and mortgage insurance premiums are layered in, pushing the payment toward $2,200 a month. That's about $300 a month, every month, for 30 years, over $100,000 in extra payments across the life of the loan. And that's before counting that FHA mortgage insurance on a low down payment loan often never cancels the way conventional private mortgage insurance eventually does. It just rides along for the entire 30 years, quietly, like a subscription nobody remembers signing up for. Here's a detail that rarely gets said out loud, though, and it flips part of this conversation. The credit score curve isn't linear. Moving from 580 up to 620 can drop an auto rate by several points almost overnight because you're crossing out of the worst pricing tier entirely. Moving from 750 to 800, on the other hand, barely changes anything because lenders already consider 750 a safe bet. The math rewards escaping the bottom far more than it rewards perfecting the top. That's genuinely good news buried inside an otherwise heavy topic. The first 60 or 70 points of recovery are worth more, dollar for dollar, than almost any other stretch on the entire scale. Now turn the page to something almost nobody connects to their credit score at all: insurance. In most states, and it's worth being precise here because a handful of states have banned this practice entirely, auto and homeowners insurers are allowed to use something called a credit-based insurance score to help set premiums. 2 drivers with identical clean records, same car, same zip code, same age, can end up with wildly different insurance bills purely because of their credit history. Industry studies have found drivers with poor credit paying, on average, close to double what drivers with excellent credit pay for the same coverage. The difference between something like $1,200 a year and $2,400 a year for identical risk on the road. If you live in California, Massachusetts, or Hawaii, none of this applies to you because those states prohibit credit-based insurance scoring outright. Everywhere else, it's quietly part of the bill. Credit cards tell the same story from a different angle. A cardholder with strong credit today can access rewards cards charging somewhere around 20% APR, sometimes lower on promotional offers, and often carrying no annual fee at all. A cardholder at 580 is usually shut out of that entire tier and pushed towards secured cards or subprime unsecured cards charging anywhere from 28 to 36% APR, frequently paired with annual fees running $50 to $125 just for the privilege of holding the card. Carry an average balance of $2,000 on one of those cards, and the interest alone can run $400 to $700 a year, on top of the fee, just to keep a balance a prime cardholder would carry for a fraction of the cost. Here's the part that should genuinely change how you picture 580 though. It doesn't just make borrowing expensive, it makes basic access expensive, or sometimes just unavailable. Try renting an apartment with a 580 score, and a lot of landlords won't reject you outright, but they'll ask for something extra, first and last month, plus an additional security deposit, sometimes doubling or tripling the upfront cash needed to move in, or they'll require a cosigner with stronger credit standing behind you. Try opening a new cell phone plan, and a 580 score can trigger a deposit requirement of $200 to $400 just to activate a line, money a 750 score never has to put down at all. Some utility companies do the same thing at move-in, a refundable deposit that exists purely because of 3 digits on a report you probably haven't looked at in months. And this is where the story takes an unexpected turn, because none of these costs show up on the same bill, or even the same day. The extra car interest shows up over 5 years. The mortgage premium shows up over 30. The insurance gap shows up every 6 months when the policy renews. The deposits show up once, in scattered moments you barely remember afterward. Add them up across a decade for a typical borrower stuck around 580, and researchers who study this tend to land somewhere in the range of $100,000 to $250,000 in additional lifetime cost compared to someone with strong credit making the exact same financial decisions. It's not one big number on one big bill. It's 1,000 small ones, spread out just far enough apart that nobody ever adds them together, which is exactly why it feels invisible while it's happening. Let's talk about how someone actually lands on 580 in the first place, because the score isn't measuring bad luck randomly, it's measuring 5 specific things, weighted very unevenly. Payment history makes up about 35% of the formula, the single biggest lever, and one missed payment reported 30 days late can knock somewhere between 60 and 110 points off an otherwise decent score, sometimes overnight. Credit utilization, meaning how much of your available credit you're currently using, counts for about 30%, and maxing out even one card can do damage disproportionate to the actual dollar amount owed. The remaining 35% splits between length of credit history, the mix of account types, and how much new credit you've recently opened. Notice what's missing from that list entirely. Income isn't in the formula. Someone earning $200,000 a year with 3 missed payments and a maxed out card can absolutely carry a 580 score, while someone earning $40,000 a year who pays everything on time and keeps balances low can sit comfortably in the mid-700s. The number tracks behavior around debt, not the size of the paycheck behind it, and that distinction surprises more people than almost anything else about this system. Now, to be fair to this topic, because it's easy to make 580 sound like a life sentence, and it genuinely isn't one. Scores move, and they can move faster than most people expect. Paying down a maxed-out card can lift a score within a single billing cycle, sometimes 30 to 60 days, because utilization gets recalculated the moment the new balance reports. A single late payment fades in relative impact after about 2 years, even though it stays on the report for 7. The heaviest derogatory marks, a bankruptcy, a foreclosure, do linger for 7 to 10 years, but even those lose most of their weight on the score itself well before they finally drop off the report entirely. This isn't a fixed identity. It's closer to a weather system than a tattoo, constantly recalculating based on the last 2 years of behavior far more than the last 10. And here's the honest exception worth naming clearly. If you genuinely never borrow money, no car loan, no mortgage, no credit cards, everything paid in cash, a 580 score barely touches your life at all. Plenty of people, especially those who came up in cash-based households or who deliberately avoid debt on principle, go years without their credit score affecting a single decision they make. The number only has teeth the moment you need someone else's money, even briefly, even for something as small as a phone plan. For everyone else, though, that moment eventually comes, usually attached to something big, a car that just died, a medical bill that needs financing, a move across the country that requires a new lease. That's usually the first time the number introduces itself. There's one more layer worth mentioning because it explains why this gap keeps widening instead of closing for a lot of families. When traditional credit gets expensive or inaccessible, people don't simply stop needing money, they shift toward alternatives that are dramatically more expensive. Payday loans, often carrying effective annual percentage rates well north of 300%. Rent-to-own furniture and appliance deals that can end up costing 2 to 3 times the retail price by the time the item is finally paid off. Buy here, pay here car lots that specifically market to subprime buyers, often charging 20% or higher on vehicles already marked up above market value before the interest even gets calculated. None of these show up in the neat comparison tables that credit bureaus publish, but they're the real destination for a lot of 580 score borrowers who get quietly priced out of the mainstream system and have to go find money somewhere else entirely. So here's the honest shape of 580 once you actually open it up. It's not a punishment and it's not a permanent identity, but it is, functionally, one of the most expensive numbers an American household can carry, precisely because its costs are scattered across a dozen invisible moments instead of arriving as one dramatic bill. A car loan that costs $13,000 more, a mortgage that costs $100,000 more over 3 decades. An insurance policy that costs twice as much for identical risk, a security deposit here, an activation fee there. None of it looks catastrophic in the moment. All of it adds up to a second, invisible interest rate charged on simply sitting at the bottom of a 3-digit scale. If breakdowns like this are useful to you, go ahead and subscribe. There's another one of these numbers getting unpacked soon. And tap that like button, because it's genuinely what puts this in front of someone before they walk into a dealership or a leasing office with no idea what those 3 digits are quietly about to cost.